A very good afternoon, everyone. Given where we stand right now, I think it's fair to say that climate change is well and truly upon us. Uh, the question now is how do we minimize the impact and build climate resilience? Uh, the theme, as you all know, it's on financing the climate adaptability. So I would like to straight go to the first panelist, Shiva. Uh, how acute do you think the need is for adaptability finance right now?
So I think one important factor to keep in mind, while statistically it has not been declared that we've crossed the 1.5-degree threshold, we've had 12 months that globally the average has crossed that threshold. So we're waiting on a mathematical tendency for that to hit, but it's clear we have crossed this point at which adaptation started to become something that was meant from a hypothetical situation of do we need adaptation resilience to be a big part of where global capital flows go, to a real problem that does need to be addressed. How we address it, I think, is still a little less clear, because mitigation did have the advantage of saying you can look at carbon markets, you can look at carbon emissions and aggregate it into one number, saying here is my current footprint, it needs to end at zero. There isn't really a simple method to say here is how water in this agricultural growing belt can be sustained, here's how we optimize strategies there, here's how we optimize weather parameters to make sure insurance products can actually get more prevalent and structured to rural areas. Those are models that will be slightly tougher to evolve, but are essential. And I think you're starting to see attention flow to those areas. Even from our perspective as an early stage venture capital fund, we're seeing those start to come through now. So I think it's a journey before those actually mature. But we are starting to see those being real problems that entrepreneurs on the ground are focusing on, saying, how do they actually find ways to address?
Right. We'll go to Pragya. So, just like developing nations and developed nations have separate pathways towards this goal of net zero, do you think corporates also in India and elsewhere, they should have a different set of pathways and not the same target, because they're obviously they're working under different circumstances?
Thanks, Sharon. First of all, I don't know if there is something called developing nations or developed nations. It depends, what's the definition of developed? Then we may be developed in a different way and others not. So let's call it the global majority, which is the global south. So yes, in the Kyoto Protocol, there is a provision for common but differentiated responsibilities, CBDR, which is allowed for every country on the planet has the obligation to try and work towards climate change, adaptation, mitigation, transitions. However, the countries which have a more mature economy would be, should lead the path, and we should be going in for the innovation, driving the technology transfer, all of that. Now, when we look at the way corporate climate action is structured, from the perspective of global standards and benchmarks, for example, the Science-Based Targets Initiative, it's the one benchmark that verifies your corporate climate action plan. There is no differentiation here. So if, for us as an investor, our portfolio extends from China to Brazil, and companies mostly in the global majority, and you see that there is a company that is based out of Germany is required to have exactly the same decarbonization plan as a company out of Brazil or India. So the divorce, the discrepancy between a national level target, which is 2070, versus the corporate level expectation on climate action is without the enabling policy framework, the infrastructure, the financing, everything else that goes with a very mature economy that allows its corporates to advance further. So companies that are based out of the global majority will always start at the back in this marathon. So they will always have a longer, steeper struggle and not the access to cheap capital and financing that we're talking about today.
Right. Also to Neeraj, how far, I mean, we have this target for the country, but how far are corporates in sync with this target?
Thanks, Shayan. So I think the corporates have definitely moved a long way, and I would anecdotally talk about a time when the definition of ESG in a SPA or a SHA document for a M&A transaction was heavily debated. Was it ecology, society, government, or was it environment, society, and governance, right? So we've come a long way from there. So clearly that understanding that, you know, ESG is actually center stage has happened. But going back to your first point, and I think that, you know, is very critical here, is that is financing that transition happening as quickly as we would expect it to be or as needed? I think there is a huge gap. So while for climate mitigation, we still see a lot of money coming in, especially I'm talking about India particularly, and you know, the kind of deals we see happen here. There is a sizable amount of money coming in for climate mitigation, but these are focused at sectors which are probably green or just, you know, almost green, I would say, right? But I think where the challenge lies is on, you know, climate financing for energy transition or climate transition and climate adaptability. These are two sectors where we don't see as much funds coming in, and even though corporates may, to give an example, you know, a company in the construction industry who's into, let's say, building affordable homes. Now, they would definitely do well if they can get some finance to understand or implement practices that make that affordable home also adaptable to, or rather climate resilient, right? That finance is not available today. So you have, like, even in the infrastructure sector, something that I do, you know, day in, day out, you see roads, bridges, highways, you know, all that being built. But how much of this is, one, sustainable? Two, how much of it is climate resilient? Is there enough technology and money chasing technology to make them, you know, resilient and sustainable? I don't think so. So have corporates understood what ESG is? Are they doing enough? Of course they are. I mean, you look at all the big names, they're doing their best in terms of reducing their energy consumption, trying to intake more green energy into their, you know, plants and facilities and operations. All that is happening. But I don't think the whole adaptability and you know, transition, finance required for adaptability and transition is still there.
To you again, Neeraj. You know, you spoke about the infrastructure development and on corporates, but is it only corporates or government also? Because you know, we in Mumbai, they built the whole coastal road, and there were studies that showed that actually could increase the risk of flood. So, you know, how do you balance this?
So, you know, I think that's more a policy level debate, because, you know, the role of urban planners or urban designers is very critical in these large scale public infra projects, which, to give an example, a city like Delhi, there is this body called the Delhi Urban Arts Commission, which is the apex body of where even the NDMC or the DDA, before they do any large infra project or any public infra project, they have to get that plan vetted and sanctioned by the Delhi Urban Arts Commission. It's almost like a regulator of sorts, right? Bombay doesn't have one, Maharashtra doesn't have one. So, you know, the BMC is free to do what they want to do, the MMRDA is free to do what they want to do. So, of course, the lack of that urban planning, the lack of urban design is evident. Time will tell how resilient the coastal road is, but yes, there have been enough, you know, hue and cry around it by the environmentalists and other urban planners that it is not really, you know, built in a fashion that will withstand the change in climate and the change in weather patterns that we are seeing. But yes, from a policy perspective, I think there is still a lot more thinking required to be done in predicting, you know, the future path of climate change and how to make our industry and economy more aligned with that.
Okay, we'll move to Ashok now. You know, could you give us a NIIF perspective on this? You know, what kind of funds are you looking at in terms of the green initiatives that you're doing right now?
Thank you, Shayan, and thank you, Mint, for giving me this opportunity to come and share my thoughts here, and thanks to the panelists who have spoken earlier to me and laid the perspective. So I'll just pick up this on the environmental risk and the projects which are happening. In terms of the risk management approach, which has to be inbuilt, and what we did at NIIF is we started off with our establishing the policy and looking from environment, social and health safety perspective, establish the processes and systems which helped in investing across about 18 investments which we have done, and across the 4 funds which we have set up with the help of like government as well as institutional investors who have come in. So the thing is, like in terms of if you take a road or any other project which has to be looked from ESG lens, like in terms of the physical climate risks which are going to be encountered in the project. So it is very important to have the assessment done from depending upon the what ESDDs throw in terms of the risk which becomes important to be looked at. For instance, in one of the road projects, we saw biodiversity as a major challenge, and that is getting impacted because of the road project. And similarly, in another project which we have seen, again I'm taking road project, where you have flood risk because of constant weather changes and all. And we have got on to detailed investigation from physical climate risk, which we saw. So I just briefly, NIIF is a collaborative platform, as many of you may be knowing. It's set up by Government of India with 49% and the rest 51% from private institutional investors. And we have got sovereign funds here, also like government pension funds like Australian Super, Ontario Teachers, Canadian Pension Plan, and rest many domestic funds also. And as a fiduciary responsibility, we have made our risk assessment for all the investments which we do. Like as I mentioned, 18 investments were there, and one we exited from healthcare, Manipal Hospital. But across all these investments, be it roads, airports, ports, logistics, or healthcare, or all the VC also, in fact, we have very good investments going on. And what we have helped our investee companies is to build their capacities on ESG, and that's the important thing which we have found. And that has helped really to look at each of the investment and address the climate risk which is there. And we have been helped by our chair at IIM Ahmedabad, which we established 2 years back to help us identify the climate risk across our investments which are happening through these 4 funds which we have. The latest fund is Indo-Japan Fund. It's a bilateral fund which we have set up, and it's purely in the environmental preservation domain. And as I mentioned, it is looking at very keenly at the risks which are coming out of hard to abate sectors also, which we follow. I'll pause here and add later on.
I'll go to Shiva. Wouldn't we require a fresh look at financial products also? I ask this because climate change has impacted, say, the crop cycles. So if crops get destroyed, how do you seek insurance? How do insurers actually assess the impact? So do you need fresher look at the kind of products that we have right now? And secondly, I'll go to Pragya with the next one on whether investors are more focused, whether the LPs are more focused on return, and maybe that's a reason why you're not seeing that kind of deployment as it should have been.
You start.
Sure. So just from our perspective, if we look at the investment products, there is definitely a need to say there is a diversity of investment products that are required to help us accelerate the mitigation process from where we stand. And just the process of all the businesses transitioning from where current baselines are to where they need to be. Insurance is an interesting one because we have been looking at the agri-insurance space specifically as well. And the challenge is climate change in some ways, but there's also the challenge of saying, how do you build an insurance product that was just anyways fundamentally better for farmers? Having a crop cutting cycle where twice a season someone physically went out to the farm once per district to assess this is the average yield for all produce in a district is not a very accurate way to de-risk the business that the farmer is in on a highly localized level. If you look at the areas affected by flood, by drought, it is going to be a much narrower geographic definition of the area. So we have invested in a company that was looking at parametric insurance, and that's a technology platform that we think is fundamentally right for this product, which is looking at how now you can get geographic and weather parameters on a highly localized basis to say, if you are looking for excess heat, excess wind, excess rain or shortage of rain in this specific localized area, I don't need to send someone out to this area. As soon as it happens, within X days, the money will hit your account, which is a way you can streamline things with technology, and you can get better climate products and better products itself to be built out for the ecosystem. So from our perspective, those are the types of investments we're still pretty excited by, and saying these are areas that the transition that technologies are bringing us to will allow us to create new businesses in these areas. Some more fundamental areas though require a little bit more work from the overall industry, and I look at this from taking a conversation we were having backstage on battery technologies, for example. These are areas where you can get very good battery technologies, new chemistries, new tools to be built out, taking on what some of the conversation with the last panel was as well. It's not easy to compete with lithium at the scale it's at today. But if you say first level prototypes that have gone out for the field in several different chemistries, there are more interesting chemistries, but globally there is a challenge of saying, how do you get the first of a kind manufacturing unit, which may have certain inefficiencies that aren't as efficient as lithium's overall value chain is at, to scale in the market. And I think getting those first of a kind and second of a kind manufacturing units to be financed in some ways, which does require not just equity VC or not just traditional debt products, which are used to underwriting in a certain way, but get alternate financial products in for those requirements is critical to help on the transition.
Absolutely, and actually just to add on there, critically the primary weightage on financing in these areas needs to be on R&D, because otherwise we're stuck in a perpetual loop of not high risk, low return, all of that. No, so thanks for the question. You know, from an investment perspective, investor perspective, what I think across multiple types of financial instruments as well, you know, whether it's debt, equity, structured finance, project financing, I think the penny has to drop and the connection has to be made to between climate risk and environmental impact and financial or credit risk. And I think the moment that becomes incredibly clear for the investing entity or the funder, you start making that correlation and your fund selection and fund composition will start building in design climate risk and environmental risk. For example, you know, structured finance project, if you are going to have those environmental impacts, lack of, you know, impacting biodiversity along the way, how to evaluate a portfolio company or a project should be on its, not just its financial returns, but its environmental returns and its social returns. So think about it like this. You may have financial returns, however, and probably on the road project, for example, you have social returns, but you have at the cost of extreme value destruction ecologically. So is that worth investing in? So from our philosophy as an investor at Prosus, what we do is we have a very clear exclusions criteria on where we don't go. We only invest in asset light business models because we do not want to go into companies that will have a net negative impact of the environment. And we really build that into our pre-investment screening phase, and then we handhold our companies on improving their ESG performance simply because that just makes them more financially viable, and when they're ready for an exit, they're ready for the obligations, compliance obligations like the BRSR that would come their way if they were in the top 1,000 brackets of the by market cap. So yes, I think you have to evaluate every project and every entity on its ability to create total returns and not just financial returns.
But then financial returns are more tangible, right? So how do you measure something like an environmental return? These projects might also have a political return, if I may say so. These road projects, apart from social return. So how do you measure the environmental returns?
So the financial returns in the short term will be tangible, but there is absolutely no doubt that there will be long-term financial erosion. It's impossible for an entity or a project to to destroy value ecologically or socially, and there may be political gains. It'll be short-term linked. The other, I think, important, there's a lot of emphasis on carbon emissions management and measuring. However, climate risk scenario analysis is not yet the norm. And I think that's where, in Europe at least, that's where we've made a lot of progress. We, for example, have done a climate risk scenario analysis across our entire portfolio of companies, everything from China to Brazil again, including our companies in India, physical risk, transition risk, all of them. Because you need to do that to know what those climate risks, what impact they could potentially have on your financial value creation.
Ashok, you want to add?
Also, like, just to add to what Prajna has said, like, in order to, like, the social protest, you have to take account for that. And once the social protest happens, your entry to manufacture or anything to do with the project, continuation, comes into jeopardy. And it has to be, you have to look for that and ensure the cordial engagement with your community around your investment which is there. And similarly, you have to take into account the entire, if a particular toll plaza is not operational because of, you have not taken into consideration the environmental issue of water logging. And if also because of water, severe weather conditions there, the entire stretch getting washed off. So how are you accounting for that, in terms of rebuilding the entire road? So those are something which we take into consideration and add into our investment analysis, which is again, as Prajna mentioned, we have a three-stage investment process, and it's run through the entire IC investment committees and all, and then presented along with these nuances on the environment, social, health, safety.
I have a follow-up to that, Ashok. So, we have been doing all this, but we have also seen that, newly built roads get flooded, tunnels get flooded, which were built, say, months ago. Apart from the builder and, say, the agency, as investors, as financiers, what are we missing? Because we are clearly doing the environmental impact, but the next rain, it just gets flooded and creates a lot of problems. So what are we missing?
As a debt provider or as an equity investor, it is your responsibility, and we take that as our responsibility to screen all the projects, and that's why I'm emphasizing on the systems and processes which were built in any funding agency or investor for that matter. And it is very important to look at all these aspects from the very beginning. You can't commit and then say that, okay, you have to now because wildlife has been spotted in that area, or for manufacturing of some two-wheelers or something, you have issues coming from the local community. You have to identify that upfront and address those through your action plans, which have to be very worked out in consultation with the various stakeholders who are there. So that way you will be able to manage the implementation as well as also reap the benefits.
Okay. Neeraj, so when it comes to climate change and M&A transactions, are you seeing some of these newer clauses on climate and probably the environmental impact of a particular transaction being built into those deal clauses?
Yeah, so not just in the transaction documents, right? Even at I think we are seeing that even from the diligence stage. So when an investor is looking at a potential platform or a target to invest, back in the day it used to be there will be 4 or 5 buckets of diligence that the investor would do, but now there is a specific ESG diligence that is done by most sophisticated investors, both domestic and international, and it is a very comprehensive ESG diligence that is done. Now, basis the findings of the diligence, of course, there will be certain clauses built into the contract, either as maybe conditions precedent to closure of that transaction that target needs to do to adhere to certain standards, be it domestic, be it global, whatever those standards are. Also, through the investment cycle, through the time that the investor remains invested, there will be provisions built into compliance and, meeting those standards and continued compliance of those standards. So it's not just in the documentation, but I think the focus is much before. While you're even looking at a potential investment, they are very serious about ESG.
So another speaker was saying earlier in the morning that climate is not just a risk; it's also an opportunity for a lot of financiers, investors. So, is that something that you're seeing on ground in terms of your interactions with the investors?
No, absolutely. I mean, if I can say, more than half of our practice runs on this, right? So clearly there is. I was telling, I think one of your colleagues, Utpal, I was telling earlier in the day that there's lots of money chasing, investments in this space, specifically in India and South Asia, if I can, or the global South for that matter. But I think and there can be more. So what needs to be done is to ease the implementation of these projects, give more policy certainty and regulatory certainty for that capital to take a considered assessment or a risk return assessment to be done at the time of investment. So I don't see there's any dearth of capital, especially when it comes to climate mitigation. Clearly not. But yes, could we do more? Of course, like, even if you look at the whole bond market, right? Today, the coupon that you see in green bonds is not very attractive. Can the government do something to better the credit rating? Can some fiscal incentives be brought in for green bond, investors? Those will, of course, if they are done, they will, of course, attract more capital. There's a huge ECB market that is untapped, right? There's a lot of external commercial capital that's available, funds ready to, put in that debt into India. But again, our current regulatory, constraints around ECB, both in terms of your spread and the caps, they aren't making it attractive. So yes, can the government do more to get in more capital for this sector? Absolutely, yes.
Just to share one of the investments which we have done. Government of India and FCDO, UK FCDO has incubated this green growth equity fund. At 140 million we had invested, both of us, and today at the final close it is 740 odd million. It's just because it's one of the first climate business which has been created, and it's the largest climate fund in the emerging markets, and it has so far invested in 7 portfolio companies, and all of them geared towards the climate, resolving the climate issues and all. So one of the company, Green Cell Mobility, I was just speaking to PMI in terms of looking at the EV buses itself in some of the places in India where buses have not been seen at all. Like I come from Kanpur, and in my childhood days I have never seen a bus plying on the streets. It's only autos or tempos. But now with GCM coming in across UP 14 depots, they have started 2 years back with 100 buses, scaled up to 1,000 buses, and it is in terms of avoiding the emissions, GHG emissions, which are otherwise coming from the ICE run buses, and also in terms of the changes which we have brought in there in terms of social issues which were tackled. And another aspect which was there, in terms of when you expose the ICE driving bus drivers to EV, there is going to be a spike in accidents, and on busy roads and all where you don't have much control on the traffic, motorized transport which is there. So in that, we have worked with the company and brought down the entire number of accidents which were reported because there were some behavioral changes which we brought in, and also like the drivers who have been like under influence sometimes had caused these accidents. So the flip side, the positive which has happened is like when we had interviews with some of the families of the drivers, they were reporting that they are very happy that money is coming back to their places. Otherwise, it would have spent on alcohol or something, and that's a good thing which is happening for many of these families. So that positive side on the community is something which these are benefiting a lot, these types of projects.
Right. To Pragya, so how do you assess the environmental impact before you invest? And for companies that you have already invested in, what kind of handholding do you do for them to reach that goal?
This is my favorite part of my job. So, pre-investment due diligence is, exactly as you just shared, Neeraj, is, understanding. Philosophically, as a group, as an M&A team, our family values as a company are that we do not invest in carbon-intense business models. And this has been socialized across all of our, the deal teams that are out there scouting for new targets. They will just by default avoid carbon-intense business models to even start exploring. And we have a whole set of exclusion criteria, pornography, cannabis, tobacco, weapons. There's a whole set of exclusion criteria, including carbon-intense business models. So and definitely, there are other due diligence pieces that are built in, which are ESG linked, which is especially because all of our companies are digital technology platforms. Data privacy is a very big one, cybersecurity, ethical use of AI, for example, in food delivery business models, how you allocate orders, is there bias built in, for example. So a lot of due diligence happens pre-term sheet. And typically, we really just do a, conditions precedent, an agreement on these are the areas that you need to work on once we come in as an investor. So that then bridges to your second question on, how do we partner? We actually handhold our companies very much because we believe that total value creation is what we are aiming for. So it's financial. And if they are able to demonstrate measurably net positive value, both environmentally, socially, and then that will translate into financial value creation for them as well. And we support them from step one. A lot of our companies are startups, scale-ups, unicorns, who are then at some point, the North Star is, an IPO listing exit. And for them to be attractive in any which way in the capital markets, ESG brilliance or demonstrating measurement and management is a most, it's the easiest way for them to attract capital or discounted capital, maybe very small discounts, a few basis points sometimes, but it is the best way for them to, and we support them in starting their ESG journey, handhold them fully, all the way to helping them on listing essentials on ESG. Across various jurisdictions, whether it's the US, which is not very high criteria or bar. I think India has a very, very, very high bar with the BRSR and reasonable assurance expected on the reported data, which is interesting to also observe.
Not stringent.
Sorry?
Not stringent.
Well, yeah, well, it takes at least 4 to 5 years to get to reasonable assurance. And I think along with just chasing profitability and demonstrating financial value, it's a huge burden on the companies to, have to also get to reasonable level of assurance on their ESG data. And it's pretty deep level data for anybody who's done BRSR reporting. You would be familiar with for a scale up and a unicorn to actually have built out the processes. So we support them on that as well. In fact, we've just signed the Green Startup Pledge, and we're on Friday we have a big workshop with all of our group companies, some of whom we share with you, to help them on their ESG listing essentials.
Interesting. We'll open the floor for questions. Please raise your hand and state your name and institution, please. There.
Myself, Shweta Anand. I'm working in DS Group as a sustainability expert. Prior to this, I was working in Adani. What I see that net zero commitment has become aligning with the net zero commitment and making a way to progress for the same has a total different route, right? So as an investor, I want to know that what is the way you take as an to assess the corporate commitment to the net zero and also the interim milestone they reach, the transition plans they have taken for the same. What's the step forward and what's the way ahead you as an investor take to assess the same?
Shall I
You
take
wanna
it?
take it?
All right, sure. Thank you. Shweta, was it?
Yeah.
Thank you, Shweta. Thanks for the question. So, very, very, very good question because it's super easy to make a commitment. And I know, for example, a few of the, there was a climate pledge, everybody signed up for it, and then they were not able to demonstrate progress, and then they were thrown out of it. SBTI, I know there were a few companies that signed up. I think the only way to demonstrate or to assess how a company is actually transitioning or is making progress on their commitments is third-party verification. So, which is why we still believe in the Science-Based Targets Initiative as a external third-party validator of not just our commitment, but then year-on-year progress on the targets. We don't rely on self-declared or self-proclaimed targets, and actually that's super dangerous because you can go in the realm of greenwashing. And therefore, really, third-party verification is the way to go, but not reasonable assurance.
Right. Do we have any more? There.
My name is Praveen Kumar Sood. I represent an organization called International Federation of Electric Vehicle Associations. Given this background, I attended this morning's event also. Today, if we are talking about electric vehicles, mostly because the visibility of electric scooters and electric rickshaws before that were there, and they are still going on the basis of their own cost economics. My questions to the panelists here is that what solutions for the carbon credit funding and startup funding you have for the medium and small industries, number one, and also I work in the green buildings foray. I was part of the GRIHA team of the TERI also. So for the green buildings also, for the architects, there are a lot of people who come over to us, and sometimes because of the lack, first of all, the lack of knowledge, and now when they are convinced that they can really implement it, it is also the lack of funds. So I'd like to hear from you as, funding organizations or funding mechanisms, some kind of an advice, and maybe next time when the Mint does these kind of programs, I would like to connect to them the medium, small, and micro enterprises. Thank you.
Thank you. Shiva.
Sure. So I can go from the built enterprise, built environment kind of backwards. So from a built environment perspective, I think there's a lot of the emissions that are sitting on that front are post-construction and saying how can you actually drive efficiencies, where we've seen a lot of solutions come out, especially for larger footprint buildings, on how IoT solutions, so Internet of Things connected devices that can actually look at current temperature control, current efficiencies, and drive efficiencies through those value chains. And when you're looking at the ecosystem of building a new construction up from scratch, I think there are some ways that we can fundamentally rethink that entire ecosystem. We're saying whether it is how much we rely on prefab as a solution, which will also reduce the overall footprint of buildings, look at new material solutions to be built in. But an incremental improvement on saying we are now only shooting for an LEED certified building, which we're going to go for every building, would increase the overall cost structure. So if we're trying to say realistically from a Indian ecosystem, we need to increase the number of overall infrastructure that we have of buildings. It is a question of fundamentally rethinking this ecosystem, which may mean new materials, relying on prefab and other new technologies, which in the Indian ecosystem, we haven't seen too much yet, but I think if there is a little bit more of an impetus that comes through, both from corporates, regulators as well, saying there will be this ecosystem, I think there is enough technologies to say, okay, now if we are now reprioritizing this for the next 2-3 years, can we get that to be part of the movement as well?